In this video we're going to have a look at Pfizer, ticker symbol PFE, a bit about the company, how the company has performed against the S&P, the dividend history, plus a look at which financial institutions are invested in the company, then onto the financials, forecasted price targets, also what a good buy price would be. My name is Alex and this is my dividend income channel. Company overview. Pfizer, established in 1849 by Charles Pfizer and Charles Earhart, initially began as a fine chemicals business. Renowned for its extensive track record of medical advancements and groundbreaking innovations, Pfizer has established itself as a prominent name in the field. With headquarters situated in New York, Pfizer operates on a global scale spanning numerous countries. If we have a look at how the stock has performed against the S&P over the last few years, if you'd invested $10,000 in June 22nd, 2013, this would have bought you approximately 406.83 shares at the closing price of $24.58. Then as of June 22nd, 2023, the value of your investment would be approximately $21,252. Based on the closing price of $38.73, that is over 112% increase. If we'd reinvested the dividends, that would have bought you 594.40 shares at an approximate value of $23,024.10. That is over 130% increase. This is an average annual return of 8.29%. For the dividend payments, you will be receiving $243.70 and $974.81 annually. In the same time period, if you invested in the S&P and reinvested the dividends, your value will be $36,292.71, a total return of 262.85%. So although the return for Pfizer is pretty decent, compared to the S&P, you would lose out on sizable gains. If you want to see how it looks over the last 20 years, you can pause the video and look at the figures on this screenshot. Over twice the gain with the S&P, something to think about when choosing your investments. Let's have a look at the dividend history. If we look at Pfizer's dividend history on Pfizer's Investors Relations page, we can see from their data they have been paying dividends since 1980, having regular increases up to the stock splits each time. 2 for 1 in 1983, same in 91, 95, 97, and the last one, which was a 3 for 1. Split in 99. It was then steady increases up to 2009, where they slashed the dividend in half from 32 cents to 16 cents to help fund the acquisition of Waith, a biopharmaceutical company, for $68 billion. It took until 2017 to get back up to 32 cents. If you were heavily invested in relying on the dividend at the time, it would have been a shock to the system. That is why being diversified is a good strategy. Now it's 41 cents, which is from a current yield of 4.23%. Let's have a look at the financials. Pfizer's market cap is currently $219.6 billion. The payout ratio is only 31.76%, which is nice and low and plenty of room for growth. Cash to debt is good at $6.07 billion in the green, which is great to see. Revenue has had some huge increases over the last 2 years, the COVID vaccination being the main catalyst for that. EBITDA has increased accordingly, which sees free cash flow, net income and EPS all follow suit. Dividends, which we talked about, we can see where the cut is, but that was for an acquisition. It's all been good progression since then. Shares outstanding, now this has been coming down since 2010, but has started creeping up in the last couple of years, something to monitor. If we look at the Q1 earnings, on paper it does not look great. Everything mostly down, 28.76% drop in revenue, 29.51% drop in net income. But this was to be expected after riding the COVID tidal wave. The demand for vaccines and COVID-19 related products has reduced significantly. Despite the lower demand for these products, it actually beat Wall Street's expectations, with EPS 24.68% higher and revenue 10.88% higher than expected. So going forward, Pfizer really needs to replace the COVID revenue and continue growing, which is exactly what they are planning to do by earning an impressive 19 new product approvals through the next year, compared to 1 to 2 a year, which is normal procedure. The Motley Fool reports in Q1, Pfizer's non-coronavirus revenue increased by a respectable 5% year over year. It expected non-COVID revenue between 70 and 84 billion by 2030, which should lead to a top-line compound annual growth rate between 6 and 10%. Pfizer made that projection before its latest acquisition. On March 13th, it announced it would buy cancer specialist Sagan for $43 billion. This should add $10 billion in risk-adjusted revenue by 2030. Pfizer CEO Albert Bourla said, "We're not buying the golden eggs, we're acquiring the goose that is laying the golden eggs." So following a year or two of declining sales, Pfizer should be more than fine. Pfizer's price to earnings PE ratio is only 11.6 as of the June 22nd. The average forward PE for broader pharmaceutical industry is 14.9, so Pfizer looks like an attractive proposition in comparison. Now let's have a look at the financial institutions buying and selling the stock. There is significant interest in Pfizer by institutional investors. The 71.02 outstanding shares they control represents a greater percentage of ownership. We can see from the top 10 invested, 6 of the top 10 have been buying, 4 have cut their positions. Looking at Capital Research with a huge 24.5 million share sell-off, it is worth noting they still own 4.1%, having 230 million shares. Big buys from Charles Schwab at 10.6 million and Wellington Management at 19.6 million. Overall, more shares bought than sold, which is good to see. Now, what do the analysts think the 12-month forecast of the stock price could be? CNN Business have an average 12-month price target of $44.50, 14.9% upside from where we are today based on 20 analysts. TipRanks have an average price target of $47.62, 22.95% upside from where we are today based on 15 analysts. And Zacks have an average buy price of $48.80, 25.45% upside from where we are today based on 15. If we look at the stock price history, it's not been plain sailing, but has been in an upward trajectory since 2009. Massive peaks with COVID. After a drop-off, it seems to have now found resistance levels between $36 and $40. The stock price had a 52-week high of $54.93 and a low of $36.17. The 12-month price targets for analysts are still below its 52-week high. On value investing using the dividend discount model, a fair price would be $44.70. With a margin of safety of 20%, a good buy price would be $35.76, which is a bit lower than its 52-week low. It's now transitioning from relying on COVID revenue to launching new products to fill that void. With the amount of products they are launching, 19 in total, there should hopefully be some home runs in there, but obviously no guarantees. Based on their successful track record with previous products, it does look like a safe bet. As usual, thanks for watching. If you've enjoyed the video, please like and subscribe.